All right. Well, it's Monday. Good Monday afternoon, folks. And if what we've been doing is a weekend research report review every Monday for the last couple of weeks. Again, nothing is promised, but we'll try to keep this process going and on YouTube for our general audience. The title of this weekend's research report from Phenom Group, and if you don't receive our weekend research reports, subscribe today at phenomgroup.com to receive the reports, as well as our weekly state of the markets, $9.99. If you want to join our trading room, get access to our trade alerts and investment ideas, become a premium member for $59.99 a month, cancel anytime. So let's get right into it. Fed-directed price action drives bearish sentiment. So one of the things that I kind of wanted to touch on also with this weekend's review is the whole idea of, well, I've moved to cash, I'm majority cash, blah, blah, blah. Right, we live in this world of social media and financial media hyperbole. And you're always hearing and seeing people talk about how they move to cash. They're 80% cash, they're 90% cash, they're all cash. Number one, if you're hearing people say that, they're either lying or basically outlining that they're just a consummate underperformer. It's hard to imagine that you could have a market perform with that kind of mentality, that you're going to sidestep bear markets, serious corrections, and otherwise. Secondly, if they're willing to tell you that on social media, what's the purpose? Like, why are you part of the financial social media construct? You know, why do you need it? I mean, if you're in cash, if you're majority cash, what do you care at this point? Right? It's generally the telltale sign that folks are not in cash. They're still engaged very deeply with the market in one way, shape, or form. And they usually are carrying risk. Maybe it's not equities, maybe it's real estate, maybe it's who knows. But they're paying attention to the markets and engaging in these discussions for a reason. It's because they're carrying risk. Some way, somehow, they're carrying risk. So the idea of, being in cash, trying to time a market meltdown and things of that nature, it's just ridiculous. And one of the charts that we had talked about several weeks ago that I re-upped for this research report was the fact that, let's say you're the best market timer in the world's best market timer, recession timing scenario here. You sell at the start, right? Let's say that you're the person you could sell at the start and you buy at the end. Your annualized returns going, including all depressions, but exclude, and here's the column that excludes depressions. Your returns are basically the same as the world's best market timer. Now, let's say you sell 1 year before the start, okay? 1 year before the start of a recession, but you buy 1 year after it ends. Again, not bad returns. Selling 6 months after the start of a recession and buying 1 year after the end of the recession, you're actually doing worse. What if you just buy and hold? Well, you beat this guy, you beat that guy, and you're only 1% shy of the world's best market timer, as if that's really, if that person really exists. So all this nonsense about, go to cash, and stop it. You're wasting your time and my time. One of the charts that I had also shown a while back was this one. Moving to cash during turbulent times and corrections is among the worst decisions an investor can make. Only thing gained is temporary solace until the market rips higher and doesn't look back, as if you were able to get into it. Remember that some of the worst days of the market are also encapsulating the best days in the market. They tend to cluster together. You get a lot of volatility, you get big down days, 1, 2, 3% down days, followed by 1, 2, 3% up days. So all of this market timing, moving to cash nonsense, it's really just about, I'm scared. Then fine, say it. Who are you trying to impress? Say it, get advice, get, an education. but trying to, pose this posture whereby you move to cash so you're not taking on any pain is just nonsense. All right, I've said this is kind of an unprecedented bear market. We've got a lot of unique circumstances going on. I mean, each of the Fed rate hikes recently has seen strong market performance, up 2%, up almost 3%, almost 1.5%, and 2.5% here this year. And then all of a sudden, the September rate hike, and we took a nosedive and have been diving further ever since. One of the things that has happened recently is that we've given up the majority of the gains and then some from the 90% breadth thrust. That's this study right here. 90% of S&P 500 stocks trading above their 50-day moving average. This was the biggest drawdown going back to 1942. So we kind of had our eyes on, this would tell us if today's breadth thrust was unique and unprecedented. And indeed it has been. We're down now 13% since the August highs, or the date that, that breadth thrust occurred, 13%. So we got to kind of keep our eyes open and recognize that, there could be more downside. This time could be quote unquote different. The reality is every time it's different. One of the other things that we've, been keeping track of as part of a, whether or not we're going to retest the lows was the fact that we've had a 50% retracement off of the bear market low. Every time that's happened since 1957, the market's moved higher. Markets moved higher and never made a lower low. Market moved higher, never made lower lows each time. It's hard to say whether or not this week, or Friday of last week, we did retest the closing low despite having a 50% retracement off of the bear market low. We retested the closing low. As of today, we're only, I want to say 6-7 points from retesting the intraday low of 36.36 back in June. Today, we hit 36.44. Here's what I'll say when it comes to this particular piece of marketology. Anytime that you're going to, revisit the former price, closing, not closing, you're retesting, right? You hit it twice, you're retesting. And since this has never happened before, again, we got to keep, our flexible approach, an open mind to, the fact that this time may indeed be very different. And, one of the things that we have to write, history is a guide. It's a very useful guide, but it's not the gospel, as Sam Stovall recently said. History is a guide. This is your history. We've never made a lower low. We've never retested the low fully after we've had a 50% retracement. We may be doing that this time. So history is a good guide, but it's not the gospel. Now, this doesn't mean that all is lost because we're retesting the former lows. If you look at this particular study, S&P 500, after 50% of a bear market was recovered, you're looking 6 months out, the percent positivity rate is 73%. 12 months later, it's 100%. Market has never been lower 12 months later after it's retraced 50% of the bear market. So all's not lost, but if we are having that retest here and now, this time is a bit different. And maybe this will also be the first time that we won't be higher a year later. I think it's doubtful, right? The probabilities are very favorable for upside. Last but not least is the fact that we are below 37.85. We had a 15% quarterly drop in the second quarter this year, the June quarter. We also had a 20% drop through the first 2 quarters of the year. Only once has the market been lower after these combined statistics, and that was in 2008. In order for us not to, be the second time in history, goes all the way back to 1946, by the way. in order for this not to be the second time, we got to get above 37.85. We had some, positive. We had some green on the screen earlier today, but that has quickly given way, as what has happened we'll get to in a little bit. So nonetheless, you want to, kind of have this line in the sand, know the values, know where we need to get to recognize if the greater probabilities going forward may or may not be achieved. The good news is, even after this decline, the next quarter in 2008, the next half of that year, and the next 12 months were very, very strong. So again, all will not be lost if we don't get above 37.85, but we may have more downside. This time may be different. A lot of sentiment. We talked about, the fund manager survey from Bank of America. The cash levels are basically higher than they were in December of 2008 and early 2003. These cash levels have only been eclipsed back in the dot-com bust. This is the Bank of America Fund Manager Survey, and it's basically just asking fund managers, how high is your cash? Now, what they say and what actually is their cash level are two different things, but a lot of people just use this as a sentiment indicator. Another sentiment indicator we talked about is right here from Ned Davis Research. And this is 1 year after 100 days of pessimism. Essentially, we've had 100 days of pessimism here in 2022. It's reached extremes, and when it reaches these extremes, historically good things do not happen. You look out 21 days, you got red here. You look out 63 days or 3 months later, the median return is negative. 126 days or 6 months later, the median return is down 6%. The good news is, a year later, it's positive every time. The median return is 19.7. I don't lend a lot of credence to this study. You've only got 1, 2, 3 prior instances. This would be the fourth. But it does give you kind of an idea of just how bad the equity sentiment is out there. You combine the fund manager survey with the Ned Davis and the AAII investor survey having 60% bearishness. And you got people that are not willing to buy the dip. You got people that are scared a recession is either here, looming. They know the Fed is tightening rates. They see housing prices starting to crack, and they're just not willing to buy the dip. That's just how bad. And it's just kind of fed on itself each and every month throughout the course of this year. One that I do kind of favor, because it does take a longer view when it comes to sentiment, is the markets in turmoil, CNBC special markets in turmoil. From the first time it airs during any markets in turmoil situation, a year later, the market has never been down. Market has never been lower. The first time it aired for this cycle was on May 5th of 2022. The market was at 41.47. If history, every single time it's green, it started these specials back in 2010. When? Flash crash, May. You think it's a coincidence, right? There's a lot of, it happened in 2020 a lot of times. We know why. But the first one ever was May of 2010. Here we are, May, 1 day later of 2022. So you might want to mark that level, 41.47. We should be higher than that if this is going to continue to be 100% accurate, because it always has been. A lot of deeply oversold conditions. Some good notes here from JP Morgan within our research report. They're looking at key levels. One of the things that I had been recently talking about was the 200-day moving 200 weekly moving average in the S&P 500, which comes in at 35.85. It's becoming increasingly likely that the S&P 500 is going to, flush that out before it finds ultimate support. One of the things that JP Morgan notes here, lastly, we would suggest fading a more aggressive slide into the 3,500 handles, as such a move would likely result in an eventual and abrupt upside reversal and price squeeze to the upside. The confluence of resistance level now in the 4,200 handles will likely mark a formidable barrier for the index. So JP Morgan basically believes that if we do get to that 200 weekly moving average and you have shorts on, you probably want to start covering those shorts from a tactical perspective and start thinking about a short squeeze or upside from there, if not reflexive because of deeply oversold conditions. And you could get a good trading opportunity to the upside. Long term, you want to stay invested, folks. Here's a key stat. We don't know where the bottom is, but once the market troughs, the average return 12 months over the next 12 months is 43.7%. You want to be a part of that. You also want to be a part of it because the worst return off of market trough was just 29%. I'll take that. I'll take 29. I'll take 43. I'll take any of the in-betweens. Stay invested. This cash nonsense, I'm flush with cash, I want to wait on the sidelines till things get better. That's not investing. It's just not. You're going to lose all of your compounding opportunities into the future by doing that. Some deeply oversold conditions. RSI finished the week in the 29s, folks. The average stock percent decline from 52-week high is now 2 standard deviations. These are deeply oversold conditions. We've talked about the McClellan oscillators at levels where you typically see a bounce. The NASDAQ new 52-week lows at 12,000 stocks are hitting 52-week lows. That's a little bit better than May, and just as bad as we were in January of 2022. A lot of stocks hitting new lows. The problem with that is you generally don't get upside until you stop making so many new lows. And there's the NASDAQ also. Last week, it actually finished just a hair below its 200 weekly moving average. Can it cut below the 200 weekly moving average and bad things not happen? Yes. It did so here in 2004. It did so here in 2010. It did so here in 2008, and bad things did happen. So it's not all doom and gloom. That's why we have to pay attention to a lot of different indicators. It proved support here in 2020, support here in 2018, a little bit just missed support here in 2016. It's not the harbinger of doom, but good things typically don't happen right away if we do see that cascade below the 200 weekly moving average. Checklist here from Oppenheimer, speaking to, if you're looking for market bottoms, these are the conditions that you want to see at market bottoms. You want to see a peak to trough duration of at least 7 months. Most bear markets without a recession average 7 months. Now, when this was first issued was back in May. So naturally, we weren't 7 months into the bear market. We are now. We're nearly 9 months into the bear market. So where this was a no before in terms of the checklist, it's now a yes. NYSE net new 52-week highs are negative 1,000. Again, in May, this was a no. But in June, it was a yes. And once again, this week, it was a yes. Or I should say last week, it was a yes. We actually equaled, I think, the number, 1,098. New highs minus new lows, which is net new highs minus 1,000. The other one was the put-call ratio, 10-day moving average of the put-call ratio, greater than 1.0. That was a no back in May. It was a yes in June. It's a yes as of last week. It was a yes again. So now with the duration finally coming to pass, 7 months or greater, the entirety of the Oppenheimer market bottom checklist is complete. Does that mean that the market is done going down? No. It means that all of the conditions are there for a reversal. We need something in the macro fundamentals to catalyze and sustain a reversal. NYSE percent of stocks above the 200-day moving average, only 15%. That's in the checklist as well. NYSE stocks above the 200-day moving average, less than 20%. It was yes back then, by the way, and it's yes again here. I went back further in time. This is what I wanted to do because I wanted to see if this double bottom here, so far as 200 stocks trading above their 200-day moving averages, meant something. And look, 2002 double bottom. This is, garbage, great financial crisis. But here in 2011, double bottom. 2015 into 16, double bottom. 2018, you had the initial stop there, but we didn't get below 25% there. So you had more of a cascading effect. But double bottoms in this particular market internal, may be telling us something, because after this, it was over. After this, it was over. After this, it was over. We'll see if this time is different for double bottoming percent of stocks above their 200-day moving average. Again, there's that put call ratio, 1.36. Folks, you have to go back to, gosh, we got this high, I think, in 2020, but before that, we didn't get this high in 2018. So multi-year high in the put call ratio, and the 10-day moving average is above 1.0. Market bottom checklist. How did the S&P 500 perform after you had this kind of a move in the put call ratio? That's what this chart tells us from Jonathan Harrier. What I focus on here, folks, is look at the average drawdown, right? Because this study is a 63-day study after you get above 1 in the put call ratio. The average drawdown is still almost 8% over the next 63 days. The good news is every time the market has been higher 63 days later, but you've had turbulence. Man, look at 2009, look at 2011, both 18% drawdowns. So imagine the snapbacks after that, right? Turbulence. I mean, that's what the put call ratio is telling you. People are hedged for additional downside. Cycle composite index, it's tracking beautifully. Right, we've had this downturn into June, kind of found our bottom here in July, rallied higher, not quite as high, right? Don't focus on the levels. Don't focus on the level, focus on the path. The level doesn't mean as much in terms of what we're trying to decipher here from the analog. It's the path. And indeed, once we hit this peak in August into September, rocky, and then boom into October. And we're doing that boom into October as we speak. So this is proving a again, just a guide. It's not the gospel, but it may be a very useful guide. All right, fundamentals, what we always go over every week, but for the purposes of this video, as a review, right, we're looking mostly at what's affecting price from a technical and or quantitative perspective. Nonetheless, we did talk a lot about, CPI, the Fed in our weekend research report, a couple of things that we continue to monitor, core CPI, because in my opinion, that is guiding all asset classes, because the Fed is, evoking its policy based on its inflation mandate. At the most recent FOMC meeting, the dot plot moved that much higher. They could possibly be above 4% on the Fed fund target rate by the end of this year. And now the dot plot is showing that they'll be at 4.6% by the first quarter of next year. And that's not where people were. That is not where people thought they would be. We look at this from Liz Young of SoFi. The Fed summary of economic projections, essentially their dot plot where they are, seeing rates go. It's projections. It's not a forecast. As early as June, Fed fund projection was 3.4% for 2022. Now it's up to 4.4%. Next year, it was at 3.8%. 2023 in June, it was at 3.8%. Now it's up to 4.6%. We go out further into the future, yeah, people think it's going to come down. But for now, that's what the market is trying to price in. That many more rate hikes. Because the Fed thinks that, inflation is not falling quickly enough. But we have, real-time data that is showing otherwise. So we talked a lot about that here in the weekend research report. What's directing traffic? The Fed's directing traffic. As they're moving rates higher, we're not seeing anything good in the way of the dollar index. It's just soaring, and it's been soaring all year long. As it's been going up all year, what's the S&P 500 been doing all year? It's been going down. We have alligator jaws here. Is this normal? No. Usually, even when the dollar's going up, the S&P 500 doesn't pay it much mind. But when you have this kind of an uptrend, we might be up 10% already this year, more than 10% in the dollar. That's going to impact multinational corporate earnings. And when it impacts multinational corporations' earnings to this degree, the S&P 500 is going to have a schism. You combine that with the rate hike cycle, and you've got the same thing taking place in the 10-year yield. Fed's moving rates higher. The bond market's pricing that in. Bond prices are going down rapidly, and the 10-year yield is going up rapidly. Again, in a normal economic climate where bond yields are just kind of ebbing and flowing, equity markets don't pay it much mind. But when you have an accelerated rate hike cycle that is accelerating yields to the upside, the S&P 500 pays it a goodly amount of mind. This is what's guiding price action. I'd love to go through 100 different charts with you. They don't mean all that much. They're basically all taking their cues from the Fed and what's happening with the dollar and the 10-year yield. Or, you can put up the 2-year, you can put up any treasury yield. They're all going higher, folks. Multi-year, if not decade highs. Midterm years, some of the data, some of history is not repeating itself, as we alluded to earlier. 50% retracement off of bear market lows may not repeat its history of never making a lower low. But we are seeing some consistency in other data. Midterm years don't usually bottom until later in the year. The average midterm year bottom for the S&P 500 is August. The median is September. So maybe we thought it was a June low, but it turns out to be an August-September low, keeping in mind that the bear market killer month, meaning what typically squashes the bear market, is October, right around the corner. And if the composite, the Ned Davis Research Composite Index is going to do that once again, it shows you right around mid-October is when markets take off. Now, the final week of October, you do get that schism basically because of the midterm elections. But after that, it's right back to the upside. We kind of saw the same thing during the presidential election. The week before, November 2nd in 2020, I think the market was down 5.8% in that 1 week. The very next week, it recaptured all of those losses, and it was up through the end of the year. So that's what's guiding markets, folks. Keep in mind, this is some really strong data when it comes to, the first 2 quarters of the year were negative GDP. It's happened before. Markets, the next 3 months, kind of a mixed bag here in S&P 500 returns after you've had 2 consecutive down quarters in GDP. But the next 1 year, pretty darn good. And you want to stay invested. Maybe we're going to have a recession called in the fourth quarter. Maybe the NBR, the National Bureau of Economic Research, decides, you know what? 3 quarters in a row, even though we have gross domestic income climbing, even though retail sales are climbing, even though we've got a robust labor market, maybe they do still call it a recession. But maybe the market has already bottomed. We don't know how deep this recession is going to be or how mild it'll be. But historically, what we do know is that the market tends to bottom on average 4 months before the recession actually ends. Markets are a forward discounting mechanism. So do keep that in mind. All right. With that, I'm Seth Golden. I hope this weekend research report review was helpful. And if you don't receive our weekend research report, please subscribe at phenomgroup.com.